All right, on this week, Paul and I are going to talk objections and reframing some of these objections that we commonly hear and still continue to hear. My favorite one will be later, in the last probably 10 minutes of the episode, so stay tuned for that one. Paul, what do we cover on here?
Yeah, well, I would just say, if you think you have objections, what you really probably have are items that just need clarification, and then you also need to dial in your education about infinite banking concept a little bit fine tuning, I would say, and then you'll have the light bulb moment, or maybe you won't. But Nelson addresses that in the book. Go back and read it.
Yeah, there you go. It's caught, not taught, as
Caught,
we all
not
know.
taught. That's right.
All right, everybody, enjoy. Hey, I'm Dave,
And I'm Paul.
and this is the Wealth Warehouse Podcast. All right, well, what's going on, Paul?
Nothing. It's enjoying a beautiful Friday. The weather here has been great. Well, we had a little bit of rain, but it's been great all week. So I've been able to take the dog out for walks. It's been like 65 to 75, sunny. Just
You're lucky.
wonderful.
You're lucky. Well, yesterday we're recording the day after the first day of spring. So we are officially in spring mode.
Right.
Yeah, I'm just waiting for the weather in Minnesota to catch up to spring. But you can see a new background right now. I'm actually recording from a different location. I joined the flying club at the local airport about 25 minutes from my house. So going to get back into flying this spring, this summer. Maybe do a little travel, flying instead of driving, so that'll be nice.
Yeah.
So I joined the club, and they've got a conference room you can reserve, and I can bring clients in here, bring friends in here, and they got a really cool bar right outside the door there that a social area for other people in the club. So yeah, should be fun, man. Maybe I'll fly down to Tennessee and see you at the new digs this summer.
Yeah. We get an airport right down the street.
Yeah,
Or
right?
you could take a seaplane and just land like right at my house.
Okay, I'll just put some skids on
Just
the
put some
aircraft I
some
get.
floats on there and be good
Yeah.
to go.
Yeah, I'll give it a try. I've never landed on water, but hey, there's a first time for everything.
Right. I've only
Can't be that
hovered
hard.
above it.
Yeah. Can't be. So my son was telling me, a helicopter pilot told him that hovering was actually really difficult to do. in a
Yeah, it
helicopter.
takes a little bit of time to learn how to do it. It's an odd when you don't know how to do it. It's an odd control input and eyes and just how it all feels at first. But
Yeah.
one day it just we call it finding your hover button. You just find it, and one day you just get it. But I remember our instructor pilots telling us to look way out. Don't look close. Look way out on the horizon. And around 5, 6, people kind of were able to do it at different times in our primary flight training. But I think around 5 or 6 hours, the first couple weeks you eventually figure it out, and then you refine and get better at it, because it's not. But at first you're basically out of control. And I remember my instructor pilot, who's a Vietnam guy with 13,000 rotary hours, was just sitting there. I was like, "Don't worry, I won't let you kill us." And I was like, "We're about to die."
Yeah.
'Cause this thing is flying me. I'm not flying this airplane.
He's seen worse.
Yeah, probably.
Yeah. No, that makes sense. All it takes is like sometimes one little sight change perspective. Like, hey, instead of focusing close, focus far away. Just like landing an aircraft. Like, you want to focus down the runway when you're landing, especially in a crosswind, to make sure everything's straightened out, as opposed to right in front of you where you're going to touch down. That makes such a huge difference. And it's kind of like thinking long range versus thinking, about only next week or next month or next year financially. You're thinking long range, and it ends up, if you can flip that switch in your mind, everything changes. So it's funny how, how do we lead right into infinite banking? That was smooth.
It's
Like
very
one of my
smooth.
landings.
Totally unrehearsed.
That was, but it was a good connection. So, what are we going to talk about today?
Well, we have a bunch of topics in our stack of topics for future episodes. and then we were just kind of chatting. We're going to talk about kind of reframing objections to the infinite banking concept. And, we have found that the only people that have objections are people that really haven't put in the necessary, I would say, academic work to understand what it actually is. Because most people that have objections, Nelson talks about proper classification of things. People are misclassifying what IBC is. It's not a product, it's a process, or it's going to take too long. We're going to address all those things today, but you really have to make an approach to the infinite banking concept, at the right approach angle. Ooh, I just did some more aviation stuff. Sorry.
Oh, look at that.
Yeah, approach angles. Steep approach, shallow, normal.
Yep.
Anyway, so yeah. So I think this is going to be good, and we don't get a lot of objections, to be quite honest.
Yeah, I mean, we handle objections, but a lot of times it's funny. I'll have conversations with people they've done their research, they want to move forward, and then they have a question, and then I may just let them talk, and then they end up. I actually heard this guy said this just the other week. He was like, "Actually, I think I just answered my own question."
Yeah.
All right, cool. Next. Like that's what you do. So a lot of times you can answer your own questions when you know enough, and a question comes up, you pose it, and then you start looking at it from the right angle. And more often than not, I think people don't give themselves enough credit that they can actually understand this as well as they really can. They think it's a mystery and it's very complex, but it's really not. IBC is simple.
It's quite simple. And you have to start with why. If you don't know why you, listener, client, prospective client, would want to become your own banker and finance the things of life using properly structured dividend-paying life insurance, it's going to be very difficult. We can't provide you the why necessarily. We can give you real-world examples, how we use it, how our clients use it, how Nelson Nash, the discoverer of the infinite banking concept, how he used it. Of course, if you read the book, you'll know. So separating why from the mechanic. The mechanics is one thing. We can explain that to you. It's really quite simple. The how, but you really need to understand the why before this is going to click for you. And it clicks for people in different ways. Numbers people, conceptual. I'm more of a conceptual guy. High level understanding. Broad strokes at first. I was like, I get it. Read that book. Yep, I get it. And then we filled in the blanks over time.
Right. Yeah, you fill in the blanks over time. You're not going to know everything there is to know even before you start your policy.
Right.
Before you pay your first premium, you're not going to know everything. And you need to be okay with that. You're going to know enough or else we wouldn't move forward with you.
Yep. And the behavior we're looking for our clients too is our clients, Nelson talks about we never arrive in knowledge. And I was listening to the Matt Walsh podcast this morning, and he was talking about a similar thing. You can have an straight A student who then stops reading, stops learning, and within a short amount of time is an ignoramus, is what he said. Yeah. And it's true. Same thing for the infinite banking concept. Our best clients, they listen to the podcast. They digest other people's content as well. They continue to read Nelson's book. Not the whole thing maybe, but they're just picking through certain sections once in a while. And that needs to be continuous. We still pick up this book, and we've read it a dozen times. I pick it up all the time and refer back to it.
Yep. All right. Well, let's start with a couple here that we'll kind of breeze through, and then we've got one that we really want to focus probably the majority of the time on. But one of the first and most common, buy term and invest the difference. So, that's a pretty easy one to object to if you understand the why, like you said, behind the infinite banking concept. Why? What's the why? What's the purpose of the infinite banking concept? Is it necessarily for death benefit?
No, although that's part of it. You can't have cash value without death benefit. But no, it's about how does one finance the things of life is ultimately what it's about. And exactly. Nelson gives you many reasons in the book. The biggest being, the all-American man and the 34.5 cents of every disposable dollar that he's paying towards interest to somebody else's banking system. whether it's a mortgage, car payment, education, personal loan, boat, and whatever it is, doesn't matter. You are bleeding interest your entire life. And that's about, the IBC is about recapturing that interest so that it can enrich you and your family instead of, the banks.
Right. So you can buy term and invest the difference, and you've got death benefit in place, but you still haven't solved the need for taking over the banking function in your life. So if that's not important to you at all, then by all means, I guess, buy term and invest the difference. But if you want to take over the banking function, you got to do things differently. Another question I would ask is, okay, buy term and invest the difference, but you still need to save money, right? The same person who says, or the same people who like to say buy term and invest the difference also promote that you save a lot of money. Well, where are you saving money? You still have to save your money somewhere. Your capital must reside somewhere. That's a truth. So where are you doing that? Well, this is just a much better place to do that over your lifetime.
Yeah, it is the ideal place to do that. And, I think a lot of Americans, Dave, they think of their 401k or their IRAs as their savings. But I was listening to that weekend financial radio show, and this guy had a lady in that had several $1 million in her either TSP. She was a career-long government employee, but she had like $5,000 in a savings account.
Right. So couldn't handle even a medium-sized emergency.
Correct. And she wasn't, she was 50, in her mid 50s, so she wasn't quite there yet to, 50, the magic number of 59 and a half. So yeah, he was like, don't put all your money where you can't get at it. And he doesn't talk about life insurance really, but yeah, maybe he's an advocate for it. I don't know, but he made a great point. I think a lot of Americans are forgetting that you still have to have cash where you can get to it.
Yeah. Where are you accessing capital in times of need or when you need to finance something? So it's got to come from somewhere. All right. We don't want to spend a lot of time because we've done entire episodes based on really that one. But okay, next. Hey, Paul, you're just in this business for the commissions. That's it. That's the only reason you sell whole life insurance. You're a despicable, evil human being, as Dave Ramsey might call you, who cares about nothing but commissions. So what do you have to say for that?
Well, I want to credit our friend, Ryan Griggs, for saying this at the think tank a couple weeks ago. It was hilarious. Yeah. He said, and I'm going to paraphrase, but this is almost a direct quote. If I were just in it for the commissions, I'd be selling pharmaceuticals. Why would I choose to sell the most maligned financial product in the world and become the most hated stereotypical salesman and intentionally reduce part of the premium where I earn the most commission? Why would I do that?
Yeah, why would I start in this business that has maybe a 5% success rate? People who get into the life insurance business, maybe only 5% of them are still around 5 years later. Right. Why would I do that just for the money?
And I would say budding agents, new agents know this to be true. I work with several new agents, and so do you. It is a very difficult business to be successful in, right? And it's just the way it is. Yeah. It's a worthwhile endeavor, of course, but it's very difficult to be great at it. As many people discover.
It's difficult to be good at it. I mean, to be good, you still, if you're good at it, you'll still be around in 5 years. But if you're great at it, if you're good at it, maybe you'll make a living doing it.
Yes. Right.
But so why? Yeah. All I care about is the money. So I decided to sell whole life insurance. Like Ned let me go out there Groundhog Day.
That's right. Single pay or whatever he says.
Yeah.
Yeah. It's, and it's like the idea being that all these other financial people that have shows that are telling you to do this and do that and that they're working for nothing.
Yeah, right. They're telling you don't buy whole life insurance because those guys are only in it for the commissions. Well, how are they making money? Are they just receiving donations as goodwill? Everybody works for money. If you're a capitalist, and I'm a capitalist, you're a capitalist, our clients are capitalists, you should get paid for bringing value and being an expert in your field. And and doing something for other people. And guess what? The more value you bring, the more money you make.
Exactly right.
And I like to ask, well, you're not the one, like, you're not going to pay me anything. The only thing you're going to pay as a policy owner, as a client, is premium to the life insurance company. If this looks like a good deal for you, and we go through this and you say, yes, this is a great thing for me and my family, I'm going to do this. Do you really care how much money I make? Why does that matter to you?
Well, I was your first client, and I didn't care, or even it didn't even occur to me to ask. Like, I wanted this. I wanted this so bad. I was ready to pay premium before this dude even had his license.
Right. So I wasn't we're not going to say I was soliciting without a license. We were just having conversations, and I was working on my license. But yeah, Paul was chomping at the bit.
No, you definitely weren't
holding up the show.
soliciting. Yeah, you were holding up the show. You sent me the book. I wanted what was in the book, and I just had to wait. Not very long. I mean, it was probably a few weeks, but
I mean, it takes nothing to get a life insurance license. Let's be honest. Which is probably why so many people join the profession, because no kidding, it's 20 hours of online training. You take a test, and you're licensed to go sell life insurance to anybody and everybody.
right.
Pretty low barrier of entry.
And it's cheap.
And it's cheap. It doesn't cost you much at all. So, which is why, I mean, how many people have you talked to over time and they're like, I used to sell life insurance?
Well, I've known more people now that I'm in the business, but I've also had a lot of people that I know get their license.
True. Yeah.
Everyone wants to whatever, but
Yeah.
it's
Yeah. Like everything, it's not as easy as it may appear on the surface. Let's just say that. So, okay. Moving on. Paul, I can get a lower. Now, actually, this may not be very valid today, but
it's not valid now.
A year and a half or 2 years ago, it was like, well, I can get a lower interest loan from the bank. Why would I borrow at a higher rate from an insurance company?
Yeah. So here's what's interesting. When rates were artificially low, so all of you people that have a 2.5, 2.75, 3%, 30-year mortgage, which, those rates were artificially low. And of course, they did damage across the economy because all the prices have just skyrocketed, for everything. And that's one of the reasons why, especially that is the reason why in real estate is the reason.
Yeah.
It's not some mysterious the homes are just increasing in value, 100% in 4 years.
The homes have done nothing to increase in value.
Correct. You just got lucky. So, and some people have been unlucky. So when rates were low, life insurance policies performed far better than savings accounts. So low interest rates punish thrifty people. So you cannot save in a savings account because you're earning nothing. You're losing money to just inflation, of course.
Right.
So you're forced to put money at risk in the market, maybe in a mutual fund or in a index fund, which is fine. Whatever you're going to do, because you're not earning money in your savings account. Now that rates have gone up, life insurance policies are still going to perform better than your typical savings account. They are, especially when you not only are they going to perform better, they're going to, you're not taxed on that growth. It's technically tax deferred, and then you access it through tax-free policy loans.
Yep.
But now that rates are kind of where they ought to be, probably, you can still get to money from against your life insurance policies cheaper than you can get it from a bank, right? I can get to money at 5.5. I think the highest policy loan rate I have on my set of policies is 7%. Mortgages are hovering between 6 and 7, I think, ish. But don't forget too, Dave, like the policy loan is completely unstructured. I don't have a repayment schedule.
Right.
In fact, I have loans out right now where I haven't made a payment in several weeks. Nobody cares.
Yeah, I go months without making a repayment sometimes.
Months.
And then yesterday I made a gigantic repayment because I had money in my account. I said, I don't need it right now to cover any expenses. Let's just put it back towards the loan. And now it's going to be available there for me to borrow again if I need it.
Right. And I think this is kind of one of the unseen advantages is just unstructured policy loans. They're just not comparable to any other loan that you, who are not a client, who do not own whole life insurance, that you don't have access to, like we do.
if you need more on that, go back to last week's episode, the replay of the live webinar, where that was the full topic of discussion, policy loans and why they are better than bank loans.
Right.
Yeah.
Far superior. Not even comparable.
Yeah. So
regardless of rate.
Right. It's funny, people had brought that objection up a couple years ago. Well, I can get a lower loan rate at a bank, so I'm not going to do it. And even at the time I said, well, interest rates rise, interest rates fall, the process of banking continues.
Yep.
And here we are now. They can't get anything for less than double digits in a personal loan. And, oh man, it would really be nice to be able to grab a life insurance policy loan now at a much lower rate than what the banks are offering. Wouldn't that be cool?
Yep.
So anyway, well, if that was your excuse a couple years ago and you realize that what we said was actually true, that rates will rise, we're still here. Come talk to us.
Right.
All right. So what I really want to dig into this next one. I've been having these conversations because I've been working with a lot of people who are mid to upper 50s approaching that retirement. And a lot of them have done very well for themselves. And one common objection I hear is, well, I've got enough assets. I've got $2-3 million 401k. I've got enough assets. I don't need a death benefit. My wife will be fine, and my kids will have plenty when I'm gone because I have enough assets right now. So this is, I had this conversation recently, and on the surface, it makes sense. Hey, you got $3 million in a 401k. You got a house that's almost paid for, or at least a lot of equity in a home. Your cars are paid for. You've got enough assets. You don't need to worry about your wife's survival, your husband's survival, your kids inheriting something or not. But the biggest question I would ask is, how much is going to be left in 20 or 30 years? When you retire,
Not much.
When you start living off of that, how much, if you live another 30 years in retirement, how much is going to be left? Like, do you know? What are the variables that could change how much is going to be left?
Well, the market performance, everyone assumes that they're going to be able to withdraw. Again, I don't really pay attention to this, but the 4% rule, for example, of taking out 4%, or maybe they're going to annuitize it in some way, like literally buy an annuity. But the question becomes, Dave, what I always think about is these people are, and I know who you're talking about, what type of person you're working with. Their income is top 1%.
Sure.
They're making 400, 500, 600. Well, when that $600,000 a year of income vanishes next year, is that $2 to $3 million really enough to maintain that lifestyle? I'll save you the research. No, not even close. It's not even close.
Right. Depending on your lifestyle, are you going to all of a sudden you retire one day and all of a sudden you're going to drop all of your expenses immediately?
Right. Same expense.
Like
right.
you're going to stop traveling. You're going to stop buying stuff, buying a new car, all this. Let me tell you, from my experience, what I've seen with people in my life who I've seen them once they retire, they're the exact same person they were when they were working. And I'm talking the opposite end too. People who were pinching pennies, people who were scared to spend money during their working years. They retire, because they want all that ready for retirement, the golden years. Well, guess what? They get to retirement, they still don't want to spend money. You're not going to change.
Right. That's right. And we know, we have, one of your friends is a guy who doesn't listen, and I know spends a bunch. And I know people like that too, that make, $300,000 a year and they can't rub two nickels together. So yeah, you're right. You're not going to change.
Yeah.
And we've talked about on this podcast how paying proper premium, owning whole life insurance, structured for IBC, is going to be a great hedge against not only inflation, but it's also a great hedge against sequence of returns risk. When the market is down and your 401k looks like garbage, you don't want to have to draw from that. Again, we've beaten this horse to death. Wouldn't it be nice to have another place where we can draw on some money without consequence until the market can recover. Or and the other thing is that we've talked about this kind of license to spend. People care about the next generation generally. I haven't really talked to anybody that doesn't care about their children and or their future grandchildren. They all want to leave something behind. Maybe it's a house. Maybe it's an automobile. Maybe it's some cash. But where that cash is coming from does matter. Wouldn't it be nice to take all of the cash that you save throughout your lifetime in your 401k and your IRA and maybe investment portfolio and enjoy that money?
Yeah.
And still be able to not only have access to capital, but also leave something behind in a tax-free, and let's face it, the simplest manner. Life insurance company looks at the beneficiary or beneficiaries and says, oh, that's where the check is going. It's as simple as that. No probate, none of that stuff.
Nope. Income tax-free cash.
Income tax-free cash.
So, yes, maybe they will be receiving something. Maybe you will have something left after living off of it for 30 years and spending it down, right? This is also indicative of people who probably haven't thought through the coming down the mountain on the other side, right? There's accumulation, and then there's spending it down. What does that look like? And what are all the risks involved? You brought up the sequence of returns risk and volatility buffer. My question is, hey, when the market's down, where are you pulling money for income? Because you still have to have income. Even when the market is down, right? You still got to live. You got expenses to pay. You got a mouth to feed or more than one. So where's that money coming from? And then you can compare options. Well, I'm just going to keep it in a high yield savings account. Okay, well that's cool right now. We can get 4%. What about when rates drop again, which they will inevitably, and you're earning nothing, like you have been, for the 15 years prior to now or 20 years prior to now.
Right. And it's, and to contrast this with when I'm 70, 75, 80, and I'm making that premium payment on, policy A or policy B or whichever policy it is, and the cash value that is created in that policy is 4 times what my premium is, is that sounds great to me. That sounds like something I would never want to stop doing. It sounds like I will regret not making those original policies that I got through you a little bit bigger, which of course I thought they were pretty large at the time, and they were, right? But man, if they had been 2 or 3 times bigger, like the other one I opened on myself a year and a half later, wow. So anyway.
Yeah, imagine by the time you retired, you had enough in permanent life insurance to equal the assets that you hold at that time. I think that's a great goal.
Yes.
To have enough life insurance equal to the amount of assets you have. Now, you should get that life insurance now so it can grow to that amount, just like your assets will grow during your working years until you retire and you start spending them down. Because then what do you get to do? You get that license to spend in retirement. Even if you're married, some people go into retirement divorced, their kids are grown, they have no expenses. They have nobody else depending on them, which is, so they're in a very confident position. Well, what if you're married? What if you have kids? What if you have grandkids with special needs? Whatever. This kind of stuff happens, especially these days. One of every 30 kids has autism, apparently, or something like that, right?
Yeah.
Maybe more. But then you get to spend your entire retirement spending down your assets at free will. Because when you retire or when you graduate from this earth, all of it's going to be replenished with income tax-free cash.
Yeah, using reason and logic, what you just said, it seems like everyone should be at least doing that at their own level. And I really think, folks, if you're on the fence and you've got the Uncle Bobs in your life who are telling you it's a stupid place to put money or you don't need it or whatever, again, just a simple question. Well, how do you know I don't need whole life insurance? Everyone that says you can self-insure or you're going to be able to live off your investment portfolio or all these things, those are all based on incomplete information. They're based on assumptions. And frankly, they're based on bad assumptions. Like an assumption is a good assumption, like in the military, right, was a future fact generally. right? That's how we treated it. A good assumption was a future fact.
Yeah. Where's your crystal ball that tells me that I don't need permanent life insurance?
Because let me tell you, you have way too many ifs in your financial plan. You don't have a viable plan. Because when something goes wrong, when the market tanks, or when somebody gets ill, or when somebody gets injured, or whatever, when somebody gets divorced, when things happen, because they do happen, life gets in the way. I'm telling you, like, just pretend it's not whole life insurance and you'll be throwing money at this thing more than you can fathom. And that's the truth.
Right. Yeah. Now, what if you need to take care of your own parents when you get into your 60s?
Yep.
Because a lot of people I talk to right now are doing that. My mom did that for like 2 years before her parents passed. You think that's not going to take a financial toll on you? Or maybe you couldn't provide something better for your parents who gave up, 18 to 20 years of their lives to support you. Maybe you could support them for a couple of years in a very generous way. Like, how cool would that be to bless your parents by saying, hey, I got you covered. You're going to live comfortably, and, it's going to be an enjoyable last couple of years on earth.
Yeah.
So, it goes both ways. You can go up the lineage and down the lineage. Why not help everybody? Or have the availability, the option to, and the resources available to do that.
That's right.
Yeah. So, all right. Well, that was good. A lot to think about. We could go on and on and on, and we will on the next episode, I'm sure. So, all right. We'll check the show notes for the next webinar coming up in April. In fact, Paul, you and I didn't talk about it, but I already put it on the calendar. I don't know if you saw it, but we got that scheduled for April, and we'll have the date, the time, the link to register in the show notes. So check that, and we will see you guys then. Until then, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle in a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.